Almost anything that we can buy and sell, we can invest or trade in. We divide these into what we call asset classes, which are groups of assets that have similar characteristics. Different people, as well as different parts of the world, could have slightly different groupings and names, but we can look at these collections of assets in general as follows. Equities and ETFs. When you own a share in the company, you own part of the company's equity, hence the name equities. So the equity markets are markets where company shares are traded. We'll talk about these in more detail later. ETFs are exchange-traded funds. A fund is a collection of assets which are included under one instrument that you can buy and sell as a group. I will explain later how these work exactly, but simply, they are created as companies with the purpose of investing or trading in specific instruments, and the shares of these companies, or the funds, are traded like other companies. Funds which are traded on a stock exchange are exchange-traded funds. Commodities. Commodities are any physical assets that can be bought and sold. Almost always, we would be talking about prices of commodities in US dollars unless it is explicitly mentioned that we are trading the commodity in another currency, which is not as common. We can divide commodities into three general categories: energy, metals, and soft commodities. Energy. One group of commodities that are traded is energy, or rather, the raw material for the fuel. Under energy, oil and natural gas are the most famously traded commodities. Metals. Almost all types of metals are traded, from aluminium to steel, platinum or cobalt to precious metals such as gold and silver. Soft commodities. Soft commodities are usually agricultural commodities such as wheat, soybeans, sugar, cotton, etc. Forex. Forex is short for foreign exchange, which is the exchange rate between two currencies. When you travel, you are almost certainly going to be involved in Forex trading, where you trade your home currency with the destination currency, even if you are using your bank card and not cash. When we talk about Forex, we always talk about currency pairs. How much is one currency worth in another currency? For example, euro to US dollar is how much 1 euro is worth in US dollar. We would also usually call the pairs by the currency's three-letter abbreviations. So in this case, we would be looking at EUR/USD. There are 8 currencies which are the most traded. These are US dollar, Canadian dollar, the euro, British pound or the pound sterling, Swiss franc, New Zealand dollar, Australian dollar, and Japanese yen. There are 7 major pairs which are the most traded in the Forex markets. You may also hear some of them being called by their nicknames. These are Euro/USD or the Fiber, USD/JPY or Gopher, GBP to USD or Cable, USD to Swiss franc or Swissy, Australian dollar to US dollar or Aussie, US dollar to Canadian dollar, Loonie or the Funds, and New Zealand dollar to US dollar. There is also a US dollar index which tracks the US dollar against a basket of other currencies, and although you can trade it, it is mostly used as an economic indicator. The symbol for this is USDX or DXY. I'll be explaining what an index is shortly. Crypto. Cryptocurrencies are relatively new to the investment world. These are electronic currencies which are decentralized, meaning that they do not belong to one central bank like most other conventional currencies. While conventional currency transactions always have to go through the banking system, cryptocurrencies allow direct peer-to-peer transactions, ensuring privacy and speed. The most famous cryptocurrency is currently Bitcoin, with quite a few others that have come along and been on the rise recently, most known of which is Ethereum, although there are differences between the different types of cryptocurrencies. Another term associated with crypto is DeFi, which means decentralized finance, which is a term that includes all aspects of the crypto universe, such as currencies, exchanges, financial services, etc. Fixed income. Fixed income investments, as the name suggests, tend to give out fixed payments. The most common fixed income instruments are bonds, which have fixed interest rates. Bonds are a way of borrowing money. For example, if a company wants to borrow money but not borrow it from the bank, they would issue bonds for people to lend them money for a fixed interest rate. These are what we call corporate bonds, which are bonds issued by corporations. The interest rates are usually decided according to several factors, most important of which include bank interest rates and how much risk it is to lend the specific company. The riskier the company's prospects are, or the sector it operates in, the higher the interest rate people will be willing to take to lend the money. Government bonds are bonds issued by central banks. In the US, these are usually called treasuries because they are issued by the Treasury Department. Most government bonds are usually bought by the banks. As a side note, I'll talk about banks and interest rates here just in case you didn't know how these work. Let's say that the government issues bonds for 1% interest rate. The banks then buy these and they know that they will be receiving 1% return on the money they invested. On the other side, they would have savings accounts for the public which pay less interest, say 0.5% every year. So if the bank doesn't do anything other than lend the money to the government using the money from savings account deposited by the public, it will make a profit of 0.5% per year. To make more money, banks then would choose to lend out money to the public, such as personal loans, business loans, etc., where they would charge much higher interest, and that's how they would earn higher profits, but they would also be taking risk by lending to the public and not to the government. Again, we'll talk about investing and trading in fixed income at a later lesson. Real estate. This one is probably one of the most understood asset classes in investment and trading. Real estate are properties, buildings, land, etc. Real estate investments usually involve buying properties to either rent out for regular income or to resell for profit and repeat the process. As explained in lesson 1, we are going to make a distinction between these two approaches, and we will call the first one investment and the second one trading in real estate. It is common to hear that real estate is usually a safe investment, but as we've seen during the extreme case of subprime mortgages, there are also times when real estate can be risky. One of the main risks of investing and trading in real estate is leverage, which means the debt one has to take on to purchase a property. The risks of being unable to meet repayments or the value of the property going below the value of the loan or mortgage was taken at are a couple of examples of this. I am not going to go into details of real estate investing and trading in this course, but I will go through some ways of using real estate in our participation in financial markets. Derivatives. Derivatives are instruments that derive their value from an underlying asset. So on their own, they don't mean anything. What does this mean? When we talk about derivatives, we are usually talking about contracts that are bought and sold, and their prices change according to what the asset in the contract is. One such type of derivatives is futures. Futures are contracts that promise to trade a specific asset in the future for a specific price. They are commonly used in commodities such as oil. Let's explain this from a real-life example. An oil trader who has warehouses where they can store actual oil barrels needs to secure oil at prices where they know will be profitable in the future. The current price of oil is called the spot price. But the oil trader needs to not only buy and sell on the spot, but also plan ahead. So they would create contracts between them and oil suppliers at specific intervals, say 1 month in the future, 6 months in the future, and so on. The oil trader will then have to have a very clear view of how oil prices will be moving over time. Later in the course, we will go through ways of doing this, but we'll just use the general idea here for now. So, for example, if today's spot price of crude oil is $60 and the trader expects oil markets to go up in 6 months due to higher demand, then they might pay $65 for the future contract that expires in 6 months. Once the contract has been issued, the contract itself will start changing hands between futures traders, and the price will depend on what the markets are seeing oil prices might be in 6 months' time. Let's look at an extreme real-life example of this. In March 2020, when the pandemic hit, the supply of oil was still normal, but demand suddenly stopped. This meant that oil traders were faced with a situation where they did not have enough space to store the oil they already bought. So what did they do? It would have cost them quite significantly to receive oil barrels they didn't have the space for. So they started to give out their futures contracts for free, or even paid others at some point to take their contracts off them. This is when oil prices went negative. Another type of derivatives is options. We will go through trading options in detail later in the course, but I'll explain it briefly here. Options are also contracts that give the option of buying or selling an asset at a specific strike price by a specified date. But instead of paying the full amount like in futures or CFDs, the contract itself is the actual instrument being traded and it has its own price. It still derives its price from the asset's value and prospects of hitting the strike price at the time of the option date, but the price paid is not for the full asset. Another advanced form of derivatives, which is not allowed in most parts of the US, is CFDs, or contract for differences. This is a contract that trades like the underlying asset at very similar prices, but rather than buying and selling the actual underlying asset, the trade is for the differences between the buying and the selling prices only. They work in a very similar way to trading the underlying asset itself. There are several reasons people choose to trade CFDs. Some of these include the ability to trade assets which are otherwise not tradable, such as indices or commodities. So one way, for example, of trading an index like the S&P 500 is to trade it through a CFD. The price of the CFD will usually be very close to the index value at the moment, so it enables trading some otherwise untradeable assets. The ability to trade using leverage. With CFDs, it is much easier to trade using leverage because it allows the broker that owns the CFD to lend as much or as little money on it as they want. This is usually where most of the risk associated with CFD trading is. Fractional trading is another advantage of CFDs, since they do not have to trade the full underlying asset, but rather they can be used to just trade the value of a percentage of the asset. This is most useful when the underlying asset is expensive, and it opens up the door for smaller accounts to trade, as well as also making it easier for more accurate positions even if size is not an issue. The ability to take short positions is also one reason people use CFDs, as it is just easy to say which direction they want to take the contracts in. We will talk about shorting later in the course. Since the broker will have to trade the actual underlying asset to offer the CFD, it means that the spread between buying and selling is usually more expensive than trading the actual assets. I'm not going to go through more details now, but later in the course, when I show you how we can actually use these derivatives, I'll give more examples and explain a little bit more. Cash. As you know, cash is an asset, and we keep it in a class by itself because it has different dynamics than other asset classes. It is usually much easier to move cash, and the value is usually just known. So when we talk later about our portfolios, cash will always be one of the asset classes that we will have to always consider because it is the easiest asset we can use immediately. And just to clarify, when we talk about cash, we don't talk about cash in our pockets, but any cash we have access to, whether this is in a checking account or in our brokerage account. Remember to write any questions you may have in the comments section, and I'll make sure that I check these regularly to answer as many as I can. Now that we know what we can invest and trade in, I'll talk about the financial markets in lesson 3, where I'll explain how they work, why we have them, how they are regulated, the different roles in the markets, and much more. See you next lesson.